and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture and journey towards my financial freedom. They will cover financial products and financial well-being so you, like me, can reach your aims and goals sometime in the future. Now let's get into this latest video. Quite simple, quite short video, but one of the most important things you need to do is you do your own research into the investments you make ahead of making that decision to purchase. Now, people will spend days, weeks researching information about what household appliances they may buy next, or they may spend weeks researching what latest model of the car they may want, as an upgrade. So when they make that purchase, they are fully aware of the specification or certain requirements they need and want to satisfy their future enjoyment when using that specific item. But unfortunately, the vast majority of investors will buy a stock or a company on a whim or a rumour from someone they know at work, in the pub, or some kind of get-rich-quick scheme or tip on a so-called social media platforms. Now, I'm not going to sell you any tips or products, but that decision will ultimately prove wrong and will result in them losing money. And what will they do? They will blame the market. They will blame investment managers who are supposedly acting on their behalf. They may, Wall Street traders, etc. Traders in investment houses work on commission based upon the number of sales, transactions, buys and sells people make. It is in their interest. They are only salesmen and they make a living from your investment transactions. They have their own interests at heart. Now, nobody should care more about your investments and your hard-earned money than you. You've worked hard through them through some kind of paid employment, where you have traded your time for money, and you should make a decision from today, to get involved within your finances. As we said, people are very quick to buy a share, and when things go wrong, they will sell at a lower price. What do? They then start the process again, maybe in haste to try and recoup some short-term losses. So the cycle continues over and over again. Not only are you selling at a loss, but it results in double the fees, costs to facilitate those investment transactions. Remember, a loss is only a loss on paper. It is only real or comes crystallized when you physically sell that asset. So what should we do to improve our success rate? Well, as part of your investment decision making process, do some research into a company, what you're thinking of buying. What are its good points, its bad points? Is it profitable and making money? Are sales or revenues growing? Does it have good cash flow? Is it burning cash? Does it have a large amount of debt which is affecting profit margins, or ultimately how the company is performing? With regard to its past history, does it have an excellent track record over numerous years? And is it moving forward to continue to grow or improve its market position year on year? So what are our future prospects looking like? What about the fundamentals or the balance sheet of the company? Take some time to read the latest reports, results or announcements from the company. Does its balance sheet look good? Does it pay a dividend to reward investors? And are those dividends increasing every year on year? Or is it paying a lesser dividend? Is it a growth company? Is it reinvesting back into the business? Ultimately, you should be buying a company, which you understand. Own that piece of a business and think of yourself as a part owner of that business. So take a vested interest in it moving forwards. And then do what most long-term successful investors do. The aim should be to buy a selection of good, great quality companies at a fair price below its net asset value, and ultimately hold on to them shares for many years in the future. It will pay off rewardingly and handsomely. And don't sell unless management change within the company or the fundamentals of that business change for a worst, shall we say, case scenario. So once you've done your research, your success, shall we say, is based on three simple factors. What is your investing mentality? What is your investing emotions? And about your processes. Avoid short-term market noise and remember, why did you buy that share or an investment in the first place? There was a specific reason. And avoid predictions. Nobody can truly predict the market, okay, on what will happen to it moving forwards. The internet is full of so-called people making predictions. They may get it right once every blue moon, okay? If all those predictions were right, they would be extremely wealthy people and they wouldn't need to be making those predictions. So finally, just to summarize, you can achieve your financial goals and aims like me if you follow simple steps by doing your research before you part with your well-earned funds or savings. Now, not all your investments will be successful. Not even the best managers get all the decisions right, okay? But you will greatly improve your chances of success if you do your due diligence, your research before you make any investment decisions in future. And as we found out during 2022, okay, there will be good years, there will be bad years, but the world of investing should be considered safe, boring, with the aim to think long term. It is not a get-rich process. If you think of the markets, say the S&P 500, the FTSE 100, they're giving an annual return of about 8% year on year for the past 100 years. So there'll be good years, there will be bad years, but it's safe, it's secure, it may be boring, but you will reach your targets, but do your due diligence. Okay? Remember, if you like the videos, smash the like button, subscribe to this channel, check out the other videos, and we'll see you again soon.